Hello friends and happy Netflix hammering day. The day has been pretty rough for anyone, I guess, who has had Netflix in their portfolios. Very big decline with the Netflix stock. I actually got a little bit interested about Netflix stock today when I saw the decline happening, and I might do a valuation on it in the future and see if there is something up with the company or not. Could there be a reason to invest in it? I have some history investing in Disney myself, so I may be interested in those two, Netflix and Disney. But never mind, that's something I might do in the future. Let's go to this video's topic. So here's the deal with this video. The other day I was in a car with my friend. We were on our way to do some sports, and he told me that he has currently lots of cash available. And this is his financial situation at the moment, but he knows he needs to use that cash after 3 years to buy a house. So he then told me that I should do a video on how he should invest his money right now, knowing the fact that he needs the money in 3 years to buy his house. What could he do in this high inflation environment we are living at the moment? How would his money be protected from inflation during these 3 years before buying of the house? So this was the task for me. Exciting task, I thought, and I said I would look into it. As I get excited about interesting tasks like this fast, I started researching what would be an ideal short-term inflation-proof any weather portfolio, whatever you want to call it, like what would I put into that portfolio. Disclaimer here though, before I go further, I am not a certified financial advisor. I don't give out financial advice here on YouTube. I just present my own opinions, nothing more than that. You have always full responsibility over your own investments. Now that we got the disclaimer out of the way, moving on. Let me now show you how my first draft for that portfolio looked like that I came up with. You can have a look at it now. I will put it on the screen here now. And as you can see, these were the asset classes I thought to put in there. First up, cash, 35%, just a reserve to exploit the volatility of the market. So if any of the asset classes we're talking about next would significantly fall, you would maybe have time to buy a little bit more of that and wait for a bounce back, or then just not use the cash at all, just keep it as a reserve in the portfolio. Then gold, 5%. Well, gold is a traditional inflation hedge, as many of you surely know. Commodities, 20%. This would have been a basket of various commodities that should usually perform really well under inflation. Some perform better, some perform better, and some perform a little bit worse. But overall, commodities are something that should do well in this kind of basket approach in inflation times, high inflation times. Then I would have put 5% to energy. This would have been a mix of fossil fuels and renewables, just to spread out the risk there. Then 20% to traditional ETFs, mainly consisting of stocks. That would have been made with spreading the risk, investing in many different types of ETFs, concentrating on many different continents, many different countries, and especially many different industries throughout all those ETFs. So very, very diversified ETF basket there. Then about stocks, well, I was thinking, should I even include any stocks in this type of portfolio? But then I decided that 5% would have been put to Berkshire Hathaway. I think many of you can agree that that's the best company out there. They are a conglomerate. They have lots of different industries inside Berkshire Hathaway, so that in itself is diversification already. For me, the price of Berkshire Hathaway is a little bit high at the moment, but according to my most recent valuation done, well, I don't know, like 2 months ago or something, I calculated that you might, if everything goes well, you might expect 9% annual return from Berkshire Hathaway still. So that would do well in this kind of portfolio I'm describing to you now. And finally, as after 3 years my friend is about to buy a house, I thought why not put 10% of the portfolio to real estate investment trusts or REITs, or then some ETFs concentrating on real estate, just to spread out the risks to yet another asset class that can be inflation proof, as homeowners usually can pass on the rising costs of inflation to the people who rent those houses, for example. This was the idea behind this 10%, and overall just spreading the risk even further. So as you can see, very diversified portfolio I came up with my first draft. And for a moment I was quite satisfied with this one. This looked like well-diversified portfolio, ready to do well in all environments, as said, especially in the one we are seeing now with the high inflation, as all of you know. And then I stopped for a little while. Yeah, I was so excited to do this portfolio building exercise that I forgot something pretty important, something I should have remembered after all the hours spent reading and listening to Peter Lynch. I have absolutely no clue what inflation or interest rates will be even 6 months from now or 1 year from now. I don't know it, no one else knows it either. We cannot predict the economy, that's impossible. So as my portfolio would look excellent today, or let's say this portfolio I just described to you without doing any checkings, I would claim that this portfolio would have done pretty well if this was your portfolio when the first day of 2022 started this year. You would have done well with this portfolio until today. But that's all hindsight. That's easy to say. This was quite depressing realization for me. That portfolio I tried to create for my friend is BS. It does not work. Or it can work if you're lucky. I don't know. The fact is that I don't know will it work for sure. Now when it comes to diversification, and this portfolio would be well diversified, diversification is needed to some extent for all investors in the world. Chance plays way too big of a part if all your money is in 1, 2 or 3 stocks or asset classes. Anything can happen in the future. Big level of diversification is good thing for everyone who do not want to spend time in learning how to invest. Just own a house, have sufficient amount of cash as reserve, and invest all excess cash to stocks or commodities via ETFs, for example, if you have many years of investing still ahead of you. In other words, you are still young. For older people, having more cash in comparison than a young person is a wise thing to do. But you can be sure that when you have a big degree of diversification, your returns will be the market average over time if you keep on investing steadily all the time. Nothing more, nothing less. So do not dream of huge returns with very diversified portfolio, because they are not possible to achieve with very diversified portfolio. Not without work, not without right judgment and more concentrated portfolio that has more winners in it than losers. Diversification works like this, but diversification itself is also not a magic cure to fierce levels of inflation as we're seeing now, unfortunately. Let's go now back to my friend's original question. How should I invest my money when I know I need the money in 2-3 years? Here is my answer, and you will be disappointed to this answer. You should not invest any money you know you will need soon. I am very sorry for this answer, but so it is. Time is investors' best friend. Time is essential for my investing. I create a story and valuation why a company is undervalued in my opinion, and once I know it is undervalued, I buy the stock. But here is the thing. I don't know how long will it take before my investment thesis plays out. How long will it take before the market acknowledges what I have seen? I have absolutely no clue. It can take much, much longer than 3 years. It can take 4, 5, even 10 years to play out. You see, this is why investing in stocks or commodities directly is completely out of question for my friend. 3 years is not enough time. If you can be flexible with the purchasing of the house and could buy it after 5 or 7 years, for example, we might need to reassess the situation here, but being strict with 3 years, there is nothing we can do. What about ETFs or REITs then? Unfortunately, especially in the monetary world we are now living in, it might be that the portfolio I described earlier does well for 2 years and crashes minus 50% on the third one. My friend would not have the money he needs to buy his house. Mission failed. There has been 14 bear markets during last 74 years in Standard & Poor's 500 index. Bear market is when the index declines more than minus 25%. Chances of this happening to you any year are 14 divided by 74, which is 19%. And I want to highlight that minus 25% is the least you can lose. Probably you will lose even more than that. Thus, the only advice to my friend would be to keep it in cash despite the inflation, or at the most consider investing in some stable countries like United States Treasury bonds, where you will too lose money because the inflation is higher than the interest rate on those bonds, at least today. But even Treasury bond is an investment that carries a small risk of capital loss. Extremely unlikely if we are talking about United States Treasury bond, for example, but still needed to be said. Anything can happen in the world. This video is then summarized as follows. 1. Never invest the money you know you need soon. 2. Time is your best friend as an investor. Do not take that away from yourself. See you in the next video. Bye bye.